short-term chart chatter, as we say, aside, it's these prices that ultimately translate into a higher physical supported stair step.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. You know, Live from the Vault is the show that goes beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis' very own world-renowned whistleblower and precious metals industry expert, Andrew Maguire. And this week, we'll, of course, be answering pretty well the community questions here we've received at Live from the Vault. So keep those questions coming in, by the way. Look in the description below, and all you got to do is click there, record your question, and you never know, Andrew may just choose your question to be answered right here live on Live from the Vault. So let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, where has this year gone? It's only 5 weeks till the end of the fourth quarter in 2025. This is amazing how fast this year has gone. And we've had a lot of very, let's call it very, very happy stackers. And they're thanking us for very accurate price projections and keeping a steady hand through the volatility that has happened in the paper to physical battle that we talk about every single week here. And from where we published our very first episode of 2025 to where we are today. So 2025 alone has netted our followers and our community here on Live from the Vault $1,500 higher per ounce gold price and a whopping $23 higher silver price. And as you reaffirmed, of course, in our last episode published only 2 weeks ago into that sell-off, you know, bearish calls for lower prices, you had not wavered. You know, your original end-of-year bullish calls for significantly higher prices. And with only 5 weeks left, all right, this is all accumulation of all the questions that we're receiving here on Live from the Vault from our community, and we're right near approaching the end of the year. Can you tell us what you're expecting as we ramp up here towards the end of the year? Over to you, Andy.
Yeah, great to be with you, Shane. Great to be with everybody again. Thanks for all the questions. Thanks for the thanks. Look, you know, I think we keep it pretty simple here. I think what maybe sets us apart is that we specialize in reporting the differences between the historically mispriced Western gold and silver pricing footprints versus where real physical supply demand structural supports lay, and how during this last 11 months since January, the fast dwindling scope of the legacy actors' ability to interfere with this physical balance is actually just limited to how many of these fast dwindling traders are left to even trust their Western exchanges anymore. I mean, we've seen so many people exiting, and where are they going? They're going into BRICS facing exchanges, which are now, the gold corridor is opened up, guys. I mean, all the institutional guys I know have gone. So that leaves a few speculators and the momentum traders, and that's all they're limited to. So what this does is telegraph that we've reached the absolute inflection point where Western CME, LBMA liquidity has permanently fractured. Now, the implications of this are completely unappreciated and continue to offer the opportunity for stackers to exploit this breakdown of a 54-year window of opportunity, really just swap your fiat dollars, your pounds, your euros, your yen, whatever, for physical gold and silver ahead of as significant a pivotal event as when Beijing took the golden gloves off on the 1st of March 2024, $2,000 ago, and the silver gloves off $30 ago. Now, these rallies may seem respectable in their own right, But during 2025, they were still severely constrained by the very wrong-footed Western cartel actors doing what they have been conditioned to do, which is throwing the kitchen sink at gold and silver. Why? Because they bet on the other side of it. However, now they're broken. They are fighting like rats in a sack, trying to short cover massive shortfalls all at once. Now, the most obvious and most difficult to hide paper to physical imbalances are hidden actually in plain sight, namely the unprecedented US-centric COMEX futures, these generated futures to global spot market backwardations, i.e. where we evidence thousands of tons of undeliverable 96% leverage futures contracts that have zero chance of being deliverable. And when they trade at a massive discount to deliverable spot and gold silver contracts, we know we have a problem. I've had so many questions on this subject. I thought we'd spend a little time looking at this and how this assists us and yourself in providing updated real-time health check, really, on the Western-based pricing system, which has really entered the palliative care stage of its 54-year-old life cycle. So many people I meet still view gold and silver through fiat lenses, which by design have left many, many investors frozen, blinded by the headlights, while their wealth progressively gets sucked into the rapidly debasing fiat vortex. For what? Maybe because they were gaslighted by their cartel megaphone to wait for a cheaper fiat price, waiting to stack some physical while missing the opportunity of a lifetime and capitalizing on the very real, rapidly closing window to seek wealth protection, which is what this is all about. Seeking wealth protection before the real supply demand price, where offers to sell bullion in dollars is out of reach for ordinary people. Look, let's take a quick look at the charts, because it does help to illustrate what we're talking about. So just to illustrate, we are just recording this on Wednesday, the 26th, and that is just before, about half an hour before the pit opens. And there's some additional volatility at this point because the Chancellor in this country is just making their budget statement. So we would expect a little bit of volatility around that. Now, in the bigger picture, we're drawing closer to the end of 2025. And to illustrate just how well physical gold and silver has acted as wealth protections since we opened this year, and here's where we opened, it now requires over $1,550 more to buy the same ounce of gold. And from where we opened in 2025, over $23 more fiat to buy the same ounce of silver. Now, what we're doing is reaffirming and in real time updating where we see these fiat to physical balance points as we move forward. Now, whereas it seemed a stretch at the beginning of the year to extrapolate the $2,900 opening price to $4,500, which was our original projection, now we've got lots of company with almost every single bullion bank looking at $4,500 to $5,000 gold in 2026. And bearing in mind, 2026 begins in just 5 weeks, and we're in sync with our very same reliable liquidity providers who are assessing a doubling of the gold price by the end of 2026. Now, we'll be tracking this closely and sharing this along the way. Now, the largest part of the move will be driven by a sudden lack of supply as Western institutional actors now seeking to move to a 40-20-20 allocation to gold from zero allocations increasingly competes with the inelastic central bank demand, where it will, at best estimate, require $8,000 gold, just scroll down, to bring sufficient bullion to the market to meet this enormous demand. There is insufficient physical to meet this enormous inflow of demand. And not to leave silver out of the equation, as we've said before, the best consensus is $80 silver, and that is in the shorter term, not in further out, which really anticipate somewhere in the region of $140 to $200. So what we look at here is for stackers to be able to shake off the smoke and mirrors legacy market shackles and to join forces with every single central bank and sovereign investor now racing to exchange their rapidly debasing fiat currencies, treasuries, for real world zero counterparty risk bullion. There simply isn't enough above ground bullion to meet this demand at current prices. That's true for both gold and silver. So let's start with the first clue, the unprecedented backwardations. This is an action call and a massive opportunity to front run the next leg higher. Futures market backwardations to spot, what they do is telegraph the legacy December gold and silver futures prices, which we've just been tracking, have been physically mispriced. Now, hang on, this is the largest the largest price setting futures exchange globally, paper futures, cash settled. So basically, these December contracts, which everyone looks to for a reference, have been physically mispriced. And while the spot market is influenced by these diluted prices influencing the local London fixes, where deliverable bullion can be sourced, because it's diluted with synthetically generated, unbacked 96% leverage COMEX supply, the exponentially larger global facing T+1 deliverable, i.e. must be delivered under Basel III compliance rules. Anything that turns up at the fix must be T+1 deliverable, 1 day deliverable physically. So these T+1 spot market fixes, they ultimately determine a global market deliverable price, and it's underpriced. However, physical market liquidity has broken free of the West's toxic gold price concoction, that's all I can think it is, into the BRICS-centric SGE and international-facing SGEI physically settled trading hubs, where a competing real supply-demand price is fixed twice a day. Now, this price is a real price. This price feeds into the rapidly expanding Western-facing gold corridor, pushing back where Western paper to global physical differences are systematically arbitraged by central banks, sovereign, and very large institutional buyers who have exited these COMEX exchanges, understanding, as the central banks do and the sovereigns do, that this is a 54-year-old legacy marketplace that is so deeply underwater from a paper to physical perspective, they become vulnerable. They're literally being targeted for this bullion. So what we're seeing is when we see periods of backwardation, this activity to arbitrage these differences actively steps up. I mean, significantly. So futures to spot foreign exchange backwardations can only exist following the creation and selling of synthetic leveraged gold supply, which determines the non-deliverable cash settle price, which is so blatantly at odds with the global physical supply demand prices. However, those that look purely are siloed within that COMEX exchange. A lot of US traders look at, and the speculators, momentum traders, chasing a dot up and down a screen, they don't see anything beyond that is the price to them. And it really is why they're wrong at both ends when suddenly they see, hey, hang on, what used to work doesn't work. So quite simply, the larger the size that I or anyone else or client wishes to buy, exponentially increases the price above the published prices, even the FX fixes, which are limited to 3 to 5 tons out of the 600 to 800 tons of unallocated gold that sloshes about. So if I want big size, then you just literally index that and add the premium. So what people try and do is literally just take a nibble at it without taking too big an order, because what it does is exponentially push that price up. However, when you've got a price being set outside of the legacy market, it's almost irrelevant. So whereas the global facing liquidity providers servicing very strong unleveraged physical central bank sovereign institutional demand, while they stealthily arbitrage these mispriced exchanged for physical basis spreads, i.e. the difference between this underpriced COMEX bullion, it's not bullion, this underpriced synthetic gold versus the real cost to buy that, even though it may be diluted slightly in the West still before it enters the gold corridor, that basis spread, EFP basis spread, is definitely stealthily being arbitraged without raising too much drama. So short-term chart chatter that you look at aside, and again, deliberate chart chatter. In other words, excuses to pull the bids. Really, as we've shown in the videos, in the chart sections, how pit managers come in, how options expiries, derivative expiries, mark-to-market events, how their footprints come in at the pit open, how these guys are desperately protecting a position, but are getting arbitraged. So what's happening is short-term chart chatter, as we say aside, it's these prices that ultimately translate into a higher physical supported stair-step. And this brings us to exactly where we are in the latest derivative gold related West to SGE wash and rinse cycled. Now we've now reached the inflection point of the current toxic wash and rinse cycle, where net of these arbitrage flows, there are no matching real offers to sell bullion for immediate delivery into current supply shortages. Backwardations reveal just the tip of this iceberg price mismatch. Now, very short term, albeit synthetically diluted global facing, that's the unleveraged Basel III NSFR compliant local London fixed prices, as they're locked in, spot indexed in other words, for T+1 delivery, it alchemizes these differences that we're talking about. And it's impossible to hide, and illustrated here. At the end of the month, derivative bets get marked to market. And it's usually just 4 business days before the end of the month. And they get marked to market. So they're contained into what is a multi-billion-dollar options expiry event, which severely compresses the undeliverable paper gold price bets against real market deliverable demand followed by a race by these bad actors to short cover these bets the instant that these synthetic prices are squared. Now, these prices affect billions of dollars of interrelated derivative bets. So basically, they're doubled down on, but causing a huge dislocation between the real price and the derivative price. Now, but as we've said many, many times in the past, see, here's the pit open. So these house capping events are most noticeable after the Asian market finishes trading, and then the house capping events commence at the pit open. Now, and this is where they appear, and we've seen it multiple times. This was yesterday's efforts. We're recording this on Wednesday. This was yesterday's efforts, but they reveal a weak hand and are capitalized on by BRICS buyers lining up at the back door to load out underpriced bullion, which they know is underpriced because the mark-to-market event forced it to be so. And this is exactly what results in a series of higher physically supported stair steps. It's exactly the same in silver. So this off COMEX market, unleveraged physical buying, it flies under the Western market radar until one of two things occur. One, sufficient 96% leveraged, siloed gold futures, long and short open interest. In other words, the speculators left who will go and buy these chips off the house, the open interest basically, which is depleting. So basically, once we've got enough, once this short open interest runs out of sufficient supply for the commercials who come in at the pit opens and derivative mark-to-market event. So if there is insufficient supply for these commercials to offset accruing unleveraged T+1 delivery obligations, that's a problem. Next, there's one. So the next thing would be that the next higher leg of the freshly established physically underpinned supply-demand support price sets the detoxified rally point. All residual naked short gold and silver ETFs, the GLD, SLV, I'm primarily talking about those two ETFs. All of these shorts have to be bought back at market, driving an even higher point to rally from. Thus, the latest in the series of wash and rinse cycles completes. Now, we talked about these ETFs in the past. We've done whole episodes about ETFs. If you can short, and you can, and there's something like 4 billion in SLV shorts, big amount of GLD shorts. What it means is if you're a shareholder in those ETFs, it's not there. The bullion's not there. To some degree, it's not there. Many people think it's not there at all. But I'm just saying it's not one-to-one. And if everyone suddenly, if there was a black swan event and you turned around as an institutional and you said, I want to cash in, you're going to get unallocated, cash settled positions. They are not going to be, everything you invested, what you thought you invested for, would be eradicated. It would be marked to fiat market, as if, in other words, you'd have lost all the wealth protection that you wanted. So that's why so many people avoid them. However, unfortunately, if you are a fund and you're not mandated to hold physical, you're forced to. You're forced to take, because it's a share. So you're mandated to buy and sell shares, but not hold physical. Therefore, you will be buying GLD, SLV. But these guys are sticky. They don't want to sell. They used to be, you'd short sell these ETFs in the hope that you could rinse out people and buy them back cheaper. They're sticky. They're not leaving. However, the moment the wrong at both ends momentum shorts, controlling 85% of all the COMEX open interest, the chips, the moment they're rinsed out, officials then begin to take the short side of these same directional momentums, who then go long. And this is the wash and rinse cycle, which is beginning to, because of the lack of this open interest, because you haven't got institutionals actually coming in and playing that game, it's a lot shallower. And so then the house, basically, they are then, because the momentums will go long after they've been short, they're going to begin to tailgate the next leg of the physically driven rally. But here's the point, from a higher support level. It is these so-called balance points that we're actually tracking and sharing with you. Now, we've been tracking this same chart for the whole of 2025. So essentially, stepping back to look at the sequence of higher physically supported stair steps commencing the moment the BIS reclassified gold as a first-tier asset class on the 1st of January 2023. In fact, they front-ran that by clearing all their 500 tons of derivative bets, buying them all back before the 1st of January, and they did that in November of 2024, which really sent the message that if you should be getting out of Dodge if you're short. So when we step back and look at it, the picture becomes much clearer. And we're tracking the spot chart here. But when we think about it, out of the 600 to 800 tons of unallocated gold cleared daily amongst the LBMA member banks, the books of the banks, there's only ever 3 to 5 tons of actual NSFR compliant gold offered at the fixes. And what that has done is prolong the official price capping efforts. Now, with only a tiny percentage of FX gold ever being offered at the fixes, Beijing moved to consolidate its position as the physical global price setting hub, opening up physically backed, and this is, if you remember this was the moment the Shanghai Futures Exchange traded on the 1st of March 2024, absolutely blindsiding every single commercial who had been, or the house, shall we say, what we call the COTs, the commercials, who were really acting on behalf of the Fed as well, and very, very profitably doing so over the years. Now, here is where this launched. And what was notable, this was the exact moment the physical liquidity spigot opened up, forcing thousands of tons of T+0 physical bullion bars to be sourced out of synthetically underpriced global stocks. Now, given that each bar has to be fully paid for before being offered for sale, a real supply-demand price began to emerge. And that is what is going on. And it is not driven by the West anymore. Also, it did not go unnoticed that the PBOC simultaneously reaffirmed its long-standing gold support mandate. Now, this unassailable mandate to back the yuan with gold stretched back all the way to 2010 in one form or another. Now it's in your face. So this was in 2010 was when China opened up and encouraged citizens to invest in gold. And then more recently, opening up access for smaller investors to be able to buy and save in gold with a click of a mouse. At every gold monetizing, de-dollarizing stage along this way, citizens were told that these RMB-priced investments would appreciate solely based on a rising gold price. And that has been assured and has been maintained. Not only does this monetize gold as the perfect wealth protection hedge into the world's largest saving rate of 43% of disposable income, it doesn't take much investment in gold from billions of people to invest a little bit in gold here or there to really affect the prices. The PBOC also steps in to take advantage of concurrent Western-induced synthetic market volatility. As we have previously assessed, Beijing has smoothed out the Western diluted pricing volatility by way of onshore CNY price management. And that feeds back into the international exchange, which is where now facing the Western institutional traders. This is really well thought through stuff and a multi-year plan that's coming into play. So this stealthy plan to take control of the gold and silver markets from the West has now expanded into a full suite, high-quality liquid asset, Western-facing gold trading and storage corridor away from the starry hands of the West. So, Shane, to really answer some more of these immediate questions, which I know we have so many of, let's look at where we are as we exited. Now, we're recording this on Wednesday. And on Monday, there was a massive options expiry, i.e. a derivative mark-to-market event. So as we exited this options expiry, let's look at where we are as we enter the largest COMEX delivery month of the year. So drilling down into this month's action, it illustrates the LBMA CME is no longer in the driving seat. It's as simple as that. And despite the kitchen sink being thrown at gold futures into what we just discussed, showed in the most recent 1 and 2 wash and rinse cycle process that we just described, how that works. And that went through, so we saw the wash and rinse cycle, we saw the 4,400 spec rinse topping out and then coming down to 3,900, which was the next major physical support level. And as we reaffirmed in our last episode, where we evidenced very liquid SGEI, central bank, sovereign, institutional buyers had aggregated higher at 4,000, which is why we said that's where support is. Liquidity buyers assessed they would provide the next major rally point following options and first notice on the Thanksgiving holiday. So when we say first notice, what we mean is all of these contracts that are now coming into the largest delivery month of the year. So options is out of the way. First notice is technically on Thanksgiving. However, first notice meaning when you have to take a 96% leverage contract and you have to fully fund it or stand for delivery or close it or roll it or do something to it. You can't just leave it in place. Now, most brokers will have their clients, speculators, force them to settle ahead of first notice, because if this happens on a holiday, you could wake up with a nasty shock. So and that would expose the broker. So most brokers would actually forcing these to be closed today. So today is kind of the first notice day, even though it's a day early. So we would expect the next major rally point to commence after today's first notice. Now, there is going to be a Bank of International Settlements squaring event on Friday, which is a very shortened session. So, you know what? I think they're going to have a tough time each and every month we've seen higher and higher and higher place for the Fed to square what they've borrowed from the Bank of International Settlements at the end of each month, the mark to market, call it the BIS event, and it'll be higher. So likely, as I say, most traders are now required to fully fund December contracts or roll these positions into, which would be the February contract would be the next most liquid contract for gold. But given the unprecedented backwardations into this largest delivery month of the year, liquidity providers are anticipating the rally to begin to get traction directly after the Bank of International Settlement leases get marked to market on Friday, if not earlier. Now, last week's synthetically driven options compression, the derivative compression, where you have this huge amount of billions of dollars worth of paper contracts that have to get marked to market. So the insiders have suppressed the price just to simply get it to that point where they can mark it to market and then run for cover. That went up to a $7.65 backwardation to spot. Unheard of, so close to first notice. Then last Friday's backwardations, we saw a low of the day in futures of 4,018 when spot was 4,022.50. Just to illustrate, this is the spot market evidencing a $4.40 backwardation, even so close, revealing an arbitrable discount was being alchemized into officials scrambling to cap underwater option sweet spots. Now, while the same paper to physical modus operandi applies to silver futures versus spot, it's just silver's not T+1 Basel III compliant. However, with global physically deliverable silver being price being determined outside of the legacy LBMA CME ring fence, the LPMCL, physical market shortages and export controls are exacerbating supply constraints, have driven the silver to spot basis spread into even larger, unprecedentedly deep arbitrable backwardations. Now, last Friday, spot gold fixed, not just intraday, fixed at a 56 cents premium to silver futures. And it went as high as 60 cents, $3,000 per contract backwardation to spot. Now, come on, why would that not get people's attention? It illustrates there was and is no LPMCL cartel supply to meet demand. They are wrong-footed. And given supply constraints exacerbated by export controls, liquidity providers assess this time around there will be little to any reverse arbitrage shipping of SGEI silver into London. So whereas last time we saw these big spreads and we saw bullion being shipped out from the US into London, Shanghai International Exchange to London, it's not happening. It's just not happening. There's the odd trader that's doing it, but no, it's not happening. No one's trusting this. These deeply backwardated conditions should not exist into a first notice event where 96% leveraged paper contracts have to be cash settled. They have to be fully funded for delivery, or you have to stand to deliver, or you're going to have to quickly roll them out to another, defer the issue and roll it out to a paper contract further out. But given such tight supply, it's as plain as day. These contracts are mispriced, and someone very big is about to take a very big hit, big enough to need a bailout. And following over 600 tons of COMEX deliveries so far this month in silver, there's still 2,000, as of today, as of last night, there's still 2,128 tons of silver warrants still outstanding. Not silver warrants. It's simply not there. Liquidity providers report very large SLV and backdoor COMEX loadouts are being accrued. This exchange for physical compression has coiled silver for a very large catch-up rally, further compounded by an upside rinse of fresh momentum short additions. Now, the silver and related 4 billion SLV naked short position has become the LPMCL's Achilles heel. Now, we'd forewarned that there would be some derivative options capping at $50 into strong spot silver demand, which is exactly what drove backwardations by up to $3,000 per contract. Now, we continue to expect capping into BIS squaring resistance at maybe 52, something like that, perhaps 53 I mean, we're already at, looking at the charts here, 52.5. I mean, I would have said 55, but I think they're going to try and keep this capped a little bit because silver heavily influences gold and they really want to square these. But the point that I'm also trying to make is that the Fed has really misstepped here because the OCC bets, as we'll just look at, the OCC bets, FX bets against unallocated silver. They don't have any silver at all to meet this demand. So what we're saying is, though, silver is quilling for a physically settled rally spring, is what we're saying. Now, we've been month after month drawing attention to the Office of the Comptroller report, where the quarterly report really started to illustrate that every single bullion bank that had been short gold and silver had removed their 5-year and further out bets short. And that was telling us they were scrambling to short cover. Now, bearing in mind that these bets, these OCC bets in gold, they can essentially, there's enough gold to actually for the BIS, the Fed, to repay their BIS bets sequentially higher and higher and higher. And it looks like once again going to end up into Friday. And we would expect a little bit of capping into the shortened Friday session as they try and close this BIS bets without getting any further deeper in the hole. But essentially, the Fed have to repay these Bank of International Settlements bets. Now, a lot of this liquidity lives in the Office of the Comptroller bets, which are really unallocated FX gold and silver bets. Now, while the Fed can print money to buy gold, and that drives the gold price higher, not so in silver. There simply isn't enough silver for the LPMCL to even source. It just simply isn't there. No matter how many dollars you print, you simply cannot buy the bullion. We're talking a huge amount of a short position that is impossible to cover. Hence, the realization that to bring sufficient silver to market to actually meet this forced short covering demand is going to require a minimum of $80 an ounce. This is a huge misstep by the Fed. And with the Fed, their agent LPMCL, the 4 banks that have really managed to contain and act on behalf of them in silver, the liquidity, as demonstrated by backwardations, the liquidity has fractured. It's just not there anymore. Also, following 39 tons of COMEX gold deliveries so far already taken out of the vaults, net of rollovers into the February contract, there's still 128 tons of gold warrants still open. And liquidity providers expect large forced EFP deliveries. So let's take a quick look at some other supporting information that is of interest. UPS also continues to raise its 2026 forecast, 4,900, in sync with Goldman Sachs, JP Morgan, alongside almost every other bullion bank, looking at plus or minus $5,000 an ounce into 2026. We've looked at higher, but this is important information that's just really starting to put the naysayers in the rearview mirror. We've also got this Financial Times. And while we've been tracking the process of Beijing's secret monetary gold purchases, where we are not the only ones now assessing these aggregations are much closer to 80,000 tons as well, it's dawning on the mainstream media that assess China's unreported gold purchases could be more than 10 times its official figures. They're grossly underestimating this. This does not come close to capturing military gold purchases which are secret and literally hundreds of tons a year that escaped customs reporting. Beijing's happy with this They've taken the gloves off. A rising gold price enables Beijing to challenge Trump and the dollar, and is a primary reason that gold's share of global reserves on a balance sheet has significantly surpassed US Treasuries. We looked at it last time, the type before. Now, while also acknowledged by mainstream media, gold's role as the only high-quality liquid asset, zero-counterparty risk investment asset, is grossly underestimated. This ECB post here is also it's beginning to dawn on Western commentators that the Bank of International sanctioned BRICS payment systems are one by one usurping SWIFT. This on the same week that the Bank of International Settlements backed Enbridge to BRICS trades were stealthily retested. Deutsche Bank, they report on inelastic gold demand, acknowledging that gold's demand is not just focused on a rising price in dollars, alongside long-standing evidence that central banks and sovereigns are diversifying fiat. In other words, they're just getting rid of their fiat into tons of physical gold. They're dumping their fiat into physical gold, regardless of a rising or a falling gold price. Deutsche Bank draws attention to their institutional clients who are also focused on accruing gold ounces. This feeds into the very sticky ETF demand that we've been drawing attention to, that is really forcing the insiders to short cover sold positions without anyone to rinse them into. Now, these are just a very few of many other bullish drivers at play. And the only question I have for you now is really, honestly, how much physical gold and silver do you own now before we look back at this opportunity window to take what is on offer while it's still on offer and to protect our wealth? That window is going to close soon.
All right, that wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you to Andrew Maguire for sharing his deep market knowledge, as you see, and for you also for tuning in and being a part of this growing global community, and for all the questions that keep coming in. Thank you so much. And if you're new here, make sure to subscribe and tap that bell right there so you'll be the first to know as each one of these episodes goes live. And if you've been with us for a while, help spreading the word about this channel by giving us a like right now. Share this information with someone who really needs to hear what's really going on. So get your questions in to Andrew Maguire. Just look down by the link below there, record your question, and you never know, you may be selected for next week's Live from the Vault episode. And with that, we'll be back again next week right here with more truth that you just won't find on mainstream media. And until there, remember what Andrew says, buy physical, make sure it's backed 1-to-1 and not that fiat stuff, right? All right. See you next week. Bye for now.